Yeah.
Okay, so the journal entry to record the write-off according to direct write-off method in which you don't have any allowance, it is simple. The RS don't want to pay us, it becomes our expense. Expense increase, debit. Since RS was our account receivable and now RS is not giving us, RS decrease is account receivable decrease, decrease mean credit, simple. So there is no allowance for uncollectible account, that's it. So in direct, entry is simple. In indirect method, or which is the allowance method, so this entry is going to be in two parts. Number one, we make a prediction. First of all, uncollectible expense to allowance. And then we charge this actual one to allowance. So if you see, the entry is the same. So this is the debit, this is the credit. So debit, credit, cancel. So you see uncollectible expense to accounts receivable. It's the same entry. Just we added a flavor of allowance, that's it. Just giving you a hint. In indirect method or allowance method, the same entry is going to be in two parts. Part one, you create allowance and then you charge this expense to allowance. That's it. Understand? And now, computing cash collection from customers. We already studied it when we were talking about ledgers, how we can use ledgers with different perspective. We talk about there as well. So let's just talk about here as well. So this is the account receivable, this is the beginning balance. So sale occurred, credit sale occurred, accounts receivable to sale, 1800. So you write it down 1800 here, right? And now what happened? Also, you write off the uncollectible accounts. So you see here, allowance for uncollectible to accounts receivable. So accounts receivable is credited with 100, right? And cash received from accounts receivable, you record the cash collection. So cash received 1500. So accounts receivable is credited with 1500, right? And this is the balance. That's it, right? So this receivable ledger or T account will give you 5 items. Number one, it gives you beginning balance, it gives you credit sales, it gives you write-off, and it gives you cash collection from customers. And it gives you the ending balance. 1, 2, 3, 4, 5. If you are given 4 items, can you estimate or can you find out the 5th item? Is just the balancing figure, that's it.
Write-offs we subtract, right?
Of course, this is the credit side, this is the debit side.
And okay, what about collections from customers? Why do we subtract that?
Because when we receive from our customer, we need to decrease the customers and we need to increase the cash. So their customer obligation is going to be decreased, right? This is customer's obligations. Understand, Misha?
I guess, yeah. Oh, because it's, all right, yeah, because accounts receivable. Yeah, I do it.
Receivable, it means customer need to pay us. So this is the balance of customer need to pay us. And they pay us, for example, here 1500. So it means their obligation is
I got it.
Understand? Good. Good question, buddy. Do ask whenever you have a problem. Okay. So this is the perfect time to clear your ambiguities.
Sure.
So even if you are not given the entries, even if you are given only 4 numbers, the balance, beginning balance, sales, and write-off. So can you find out cash collection from customers? It is just a balancing figure. So you see here, this is 2,000, 200 plus 1,800, 2,000, and it is 100 here, and the balance is 400. It means the debit side is 400 greater than the credit side, right? So it means here must be total 1,600. And if you see that, it should be 1,500. So by putting 15 here, this is total 1,600, and now this is justifiable. Debit side is 400 greater than the credit side. So this is not like that. This is not the traditional mathematical balance. Remember, this is the debit balance, and debit balance means the debit side is 400 greater than the credit side. It's not like that. Okay, this is 2,000. Okay, 2,000 minus 100 is 1,900. No, no, it's not like that. When you balance the accounting ledger, it is balancing is that you will write it down which side is greater. So this side is greater, and then this is the debit side. The debit side is 400 greater than the credit side. It means if you write it down here, it is 2,000 minus 100 minus 400. That will give you 1,500. Understand? So the receivable gonna give you 5 different items. If you are given 4, you can find out the 5th one easily. Just manipulation of the figures, that's it.
400. I can read your numbers, sir. It's 2,000 minus 100 minus
400. Answer is 1,500.
Oh, okay, I see.
Or you can say that 200 plus 1,800 minus 100 minus the balance 400. Answer would be, or just follow the logic that is debit side is 400 greater than the credit side. That's it. And now we just finished the treatment of account receivable. Now let's just talk about treatment of notes receivable. So we know that note receivable is the loan that we have given to some other businesses or our employees as an advance, and on note receivable we receive interest. We receive interest. Remember, this is receivable, not the payable. On notes payable we pay interest. On notes receivable we receive interest. That is our interest income. So here, the terms here, party to whom you pay the money, to whom money is owed, debtor, the party that borrowed and owes money, interest, maturity date, maturity value, principal, and term. That is simple one. Terms and conditions going to be there. Principal amount going to be returned. For example, this is $1 million I have given you. This is called principal. Maturity value. On the maturity of the date, you are going to give me $1,001,000. For maturity date for 1 year or 6 months, whatsoever. Interest rate going to, for example, 9% or 5 or 10% whatsoever. Name of both lender and debtor going to be written. So this is the typical example of promissory note or notes receivable. So this is the amount of here. This is the amount of principal written here. This is the issuance of date 31st 2014. I promise to pay to the land to the pay to the order of this bank 1,000 and number of $100 on February 28, 15, which is plus interest at annual 9%. Right? So you see that number of 1,000 you are going to give them at a percentage of 9% interest with 100 days. Not 100 days. With I think this is 9 months or something. Whatsoever it's the amount. So interest going to be mentioned here. Principal going to be mentioned here. The person who is receiving money, his signature is there, and lender is here. So I'm just gonna be going through that. How much time left? Let me see that. Okay, we have just 15 minutes left. Okay, so if we are issuing receivable, what is the entry? So Continental Banks gives Lauren 10,000 cash. Entry would be not receivable to cash, simple. And when close of the fiscal year, so remember how the date is. Did they mention the date? No. The date is for August, right? August, which means 1st September. So from 1st September to December 31st is 3 months, right? So bank has the right to collect 3 months. No, September, October, November is for 4 months, sorry. From 1st of September to 31st December, 4 months. So how we calculate the interest? 9% multiplied by 4 by 12, $30. Since you are going to pay back on February 28, right? So it means the bank has the right to record the interest, but interest is not received. Entry would be interest receivable to